I've seen financial models really like create a lot of value for companies in my career. And I find that they're not always the easiest things to build, they're not always intuitive to folks. So we're really going to dig into that and try to unlock that, for you today. What is the power of a financial model? How can you use it? I'm Steven Plappert. So I'm a serial entrepreneur out of Louisville, Kentucky. I've started two companies. I've taken them both through Techstars. I've raised a little bit over 10 million in venture capital in my career. Just recently, closed 4.5 million for Forecastr. So that's exciting. And I built a lot of financial models. My first company was a consumer company. I failed it back in 2016, so I know what that's like. I spent 4 years building financial models for companies, all sorts of companies, startups, SMBs, all sorts of different business models and stuff like that. We'll get right started. So what is a financial model? A term that gets used in a lot of different ways. We think a powerful way to think about a financial model is a business simulator. Its job is to basically simulate your business into the future from a financial perspective. So, what is your revenue going to look like? What are your expenses going to look like? What about your hiring plan? What does that say about your cash at the end of the day? When are you going to become a billion-dollar business, right? Like, from a financial perspective, we're simulating you into the future. And there's a lot of reasons why you might want to take your business on a virtual test track like this. The two main reasons is, one, to impress investors and tell that story. If you're looking to approach investors, specifically financial investors, then you need to tell a great financial narrative. You need to tell the narrative of how you're going to become this big business that sells and generates them a lot of ROI. In a similar way, if you're building a business that has an impact bend, right, and you're pitching impact investors, like, you need to be telling that story as well. Like, it's all about storytelling. Fundraising is. And the financial models are it's a really effective way to tell your story with numbers. And so that's a big part of it, is to tell that story and to communicate to investors that you've done the hard work of thinking through how your business is going to work from a financial perspective. And you can articulate that to investors. So there's a storytelling, fundraising element to it. And that's the one I find that a lot of founders, first think of. The real value, though, of a financial model is actually more on this piece here. It's about making decisions. It's about setting goals for your company that are rooted in how your business works. And it's about holding yourself accountable to those goals. It's about making sure you don't run out of cash. It's about making the right decisions on the treacherous path towards, the pot of gold at the end of the rainbow. And there's a lot of twists and turns, and it's not always obvious what decision to make. And a model can really help you make the right decision. It can be kind of an advisor that helps you make the right decision. And we'll look at that a little bit as we dive into a financial model. So it's about setting goals. It's about managing cash. It's about fundraising. Those are really the main reasons why we build a model. So what is the output of a model, right? The model is this calculation, series of calculations, this kind of this simulator that you put inputs into, right? You put assumptions into, historical data, things like that go into it. And then out the other end comes a set of financial projections. You're ultimately looking for all three financial statements forecasted monthly out the next 5 years if you're fundraising. So you want the income statement, the balance sheet, the statement of cash flows. Those are the three main financial statements that finance professionals use to understand the health of a company. Those are the three statements that your accounting would produce doing your monthly books, or that public companies would report on. And so you want these three statements, one, for fundraising, so that you can communicate to investors that this stuff. And if you have a model that produces these three statements, that's a signal to that. The other is that operational side. When your accounting spits out these statements every month, you want to be able to compare that against your model to understand what you hit, what you didn't hit, and to use that comparative process to tune the model to reality. And to change your behavior to hit your goals. That's what good management looks like. So you really want that three-statement model, we call it, monthly out the next 5 years. Monthly because a lot can happen in a quarter or a year, so you want good visibility. Next 5 years, if you're fundraising, if you're just looking to run the company, 18 to 24 months is fine, but 5 years is really what's expected for fundraising. because you do want to show what the long-term view of the company looks like. What does your company look like at maturity? So we'll see these projections in action when we look at the model. But that's kind of the output of the model that we're looking for. When it comes to building a model, we know why we're going to build it: to impress investors, to make better decisions, to set goals. We know what it's going to spit out, but where should we focus our time? There's a lot that goes into building a model, as we'll see, and not everything's created equally. In our opinion, most of your energy, your effort, your focus should go into revenue, and should go into what we call the revenue formula. Because revenue is the part of your business that's typically the riskiest. It's typically the most difficult to control. It's the most difficult to predict. And most companies fail because they're not able to generate enough revenue quickly enough to, either become profitable or attract new investment. And so they end up running out of cash. So it's revenue that is kind of the whole kit and caboodle, right? If you can really understand your revenue, if you can understand how to generate leads and how to acquire customers and how to monetize them, how to keep them, if you can really understand that mechanically, and you can kind of apply leverage on the metrics that drive revenue the most, you'll have a really good chance of success. And so that's one of the main tenets of a financial model. Is the first thing you do is get clear on the revenue formula. An example revenue formula. Everybody's revenue formula is a little different. They fall into standard kind of shapes and sizes, right? Like a SaaS business model or marketplace or transactional or e-commerce, but everybody's is a little bit different. The way to go about building a revenue formula is you just kind of have to logically think through, well, how do I generate revenue? Like, let's say if you're a SaaS company, start with a simple revenue formula. Like, well, I'm a SaaS company, I'm a subscription company, so revenue is subscribers times price. That's the first step on the journey. That is a revenue formula. Subscribers times price, equals revenue. We can take that one layer deeper, though. We can go deeper. We can say price. I can control price. Subscribers, we can unpackage that. We can break that down into subscribers last month minus the ones I lost plus the ones I gained. I can take that one layer deeper and say the subscribers that I lost is like the ones last month times the churn rate. The ones that I gained, I could break down by channel. Maybe I'm using a number of different channels to generate leads and acquire customers. Maybe these channels are Google, email, and Facebook. Or maybe they're not. Maybe it's a direct sales channel. Maybe I have a sales team and they're going out and they're kind of hunting for leads. Or maybe it's a partnerships, or maybe it's affiliate marketing or influencer marketing. There's lots of different strategies you could use to drive new customers. But so you want to break that down. You want to forecast that on a channel by channel basis so you can understand which channels are ultimately driving revenue the most. So you could break your new customers down by channel. And then you could ask yourself, well, how do I actually acquire customers for each channel? Maybe it's a paid advertising channel and I'm spending money on a budget. I have a budget divided by a cost per click gives me traffic. Traffic times conversion gives me new subscribers, and on it goes. So, so you're really just trying to take revenue. You're trying to break it down and all the metrics that feed into revenue, which typically come in four kind of categories. There's top of funnel metrics. So how do you generate awareness? How do leads enter your funnel, whether that's a B2B, B2C, B2B2C, funnel, right? Whoever the customers you're selling. So you got leads coming in the top, that's top of funnel. You have some kind of conversion metrics. That's how you're in this case, this would be a conversion metric. This would be top of funnel metric. And conversion metrics take you down to customers, which would be like these new subscriber metrics here. And then you have more of your monetization metrics and retention metrics. So price, would be one element of monetization, and then retention over here would be another. What do you charge somebody on day one, and then what mechanisms do you generate more revenue from them as time goes on?